Welcome to this deep dive. So this week you might look at the markets, the S&P 500, and think, well, not much happened. It finished fractionally lower, right, after just touching 6,500.
Right, seemed quiet on the surface.
Exactly. But underneath that calm surface, there was a real flurry of activity. Significant economic data dropped, creating these, well, complex cross-currents.
A real tug-of-war, you could say.
That's a great way to put it. So our mission today is to navigate that tug-of-war for you, this tension between surprisingly strong growth and a noticeable jump in inflation.
And what's really fascinating is how these signals create like a delicate balancing act for the Federal Reserve. It's quite the puzzle.
Definitely. We need to unpack the key data points setting this up and maybe touch on gold hitting a new record and look ahead, of course.
Absolutely. Those data points really set the stage for potential volatility.
Okay, let's dive right in. Two key numbers really tell the story this week, pulling in opposite directions. First, the good news, I guess, economic growth.
Yeah, the second quarter GDP figures.
Right. They revised them upward to a pretty strong 3.3% annual growth rate. That seems like solid economic momentum, wouldn't you say?
Oh, absolutely. That upward revision, it genuinely shows some real underlying strength. More than many were expecting, frankly. But, and this is the crucial bit, when you see that kind of strength, it makes the other piece of data, well, it makes it even more critical for the Fed. Puts it under a microscope.
Okay, so here's where it gets, really interesting, a bit confusing maybe. Despite that solid growth, inflation, the Fed's preferred measure, the core PCE index.
Yeah, stripping out food and energy.
Exactly, the one they watch closely. It actually rose, came in at a 2.9% annual rate.
Which is its highest level in 5 months.
5 months. So strong growth and rising core inflation. How did the Fed even deal with that?
Well, that's the million-dollar question, isn't it? It really complicates the path forward for monetary policy. Massively.
Because they have two jobs, right? Keep employment up and prices stable.
Exactly. They're dual mandate. And when you have strong growth pushing potentially on employment, but inflation ticking up, they're caught. It's a classic bind.
Okay, but here's the thing. Despite all that, the market seems, totally convinced a rate cut is coming soon.
Yeah, the bond market pricing is pretty striking.
It really is. They're implying like an 88.9% chance the Fed cuts rates at the next meeting, September 17th. That's almost locked in, according to traders. How does that square with the data we just talked about?
Well, it shows the market is looking past the current data points or maybe weighing other things more heavily.
Like what?
Like signs of softening elsewhere. We've seen some recent housing data that looks a bit weaker, maybe a cooling trend starting in the labor market,
Okay, so they're betting those are the leading indicators.
Kind of. The market seems to be anticipating that the Fed will see those cooling signs and prioritize keeping the economy going, maybe preventing a sharper slowdown over tackling this specific inflation number right now.
So they're betting the Fed blinks on inflation.
Essentially, yes. Or that the Fed views this inflation bump as temporary. But this disconnect, where the market expects easing even with some strong data, that really sets the stage for potential volatility.
Right. Because if the market's wrong and the Fed holds, or even hikes.
Oof, yeah. That could cause a pretty sharp reaction. Bond yields could jump, stocks could stumble. It really raises the stakes for that September meeting. Which signal will the Fed prioritize?
Okay, and amid all this uncertainty, this push and pull, one asset really stood out this week, gold.
Ah, yes, gold.
It hit a new record high, didn't it? Over $3,500 an ounce. What's that telling us?
Well, $3,518 per ounce, to be exact. And it's a classic signal. It shows clear investor demand for inflation hedges.
Meaning people are trying to protect their money from rising prices.
Exactly. But it's also more than just general inflation fears, I think. It signals real anxiety about which way the Fed will jump, Uncertainty about monetary policy often drives investors towards perceived safe havens like gold.
Makes sense. Okay, so looking ahead now, we have a holiday-shortened week coming up.
Right.
But Friday looms large. The all-important monthly labor market report. Jobs numbers, unemployment.
Yep, that's the big one. It's one of the last really critical pieces of information the Fed gets before that September policy meeting.
It's a lot riding on it.
Huge amount. If that report comes in way off expectations, hotter or colder, it could have a substantial impact on market sentiment and ultimately on your investments.
Okay, so summing up, a week where strong growth clashed with rising inflation, yet the market is betting heavily on a rate cut. The stage is definitely set.
It really is. And it leaves a big question hanging there for you, the listener. How is this upcoming jobs report going to influence the Fed? And what happens when this growth versus inflation battle finally resolves? What does that mean for the economy and for your financial picture heading into the fall?
Keep a close eye on those job numbers Friday.
Definitely. They could be pivotal.